Good afternoon, and you're very welcome to this webinar on the Corporate Sustainability Reporting Directive, or CSRD, and building finance and IT partnerships. My name is Susan Rosney, and I am Sustainability Officer with Chartered Accountants Ireland, where I lead on advocacy and communication on sustainability for the Institute. A quick intro to our topic today. We know that finance professionals are working hard to understand the implications of the CSRD and to implement the necessary reporting for their businesses. But their colleagues in IT are playing a vital role in this. As our first speaker, David Codd, will tell us, and apologies for spoilers for this, you can't deliver CSRD compliant reporting on your own. Partnering with IT is vital. During this webinar, our speakers, David Codd and Paul Power, will discuss how to establish effective collaboration between finance and IT teams. There are pitfalls to avoid, so they will cover those, and they will also describe how to build a strong partnership to deliver an effective sustainability reporting programme. David is our first speaker, and he is a Fellow of Chartered Accountants Ireland and is a transformation and strategy consultant and non-executive director. He has extensive experience in leading strategic change, acquisition integration and technology programs, and his previous roles include Group Transformation Director and Group CIO of Musgrave Group and Finance Director of Booker Retail in the UK. Paul Power is the Global IT Sector Lead with DHL Group, and he leads DHL's IT solutions for their engineering, manufacturing and energy sector customers globally. Paul is an experienced IT and organisational change leader, and his previous roles include IT Director for DHL Supply Chain Ireland, Hungary and Poland. Now, before I hand over to David, I wanted to let you know that you can ask questions using the Q&A function in Zoom, and I'll be monitoring that throughout the session, and we'll put those questions to our speakers. Please also note that this webinar is being recorded, and we will send the slides to attendees after the event. But now, David, it's over to you.
So much, Susan. Hello, everybody. As Susan said, you can't deliver CSRD compliant reporting on your own. Partnering with IT is vital. Let me explain why. Implementing reporting of this scale at pace is a big challenge. The breadth of activities and scope is usually extensive. You may have to collect data from new sources. Some of the measures will be new or at least unfamiliar. The quality standards are now higher, and it's possible that some of the data you need simply doesn't exist anywhere yet. So you'll need technology to build effective reporting. And this means that the strength of your partnership with IT is the critical success factor. This webinar will focus on how to make this IT partnership work. Susan said, I've been involved in all sorts of changes, ranging from business-wide strategic transformation to mergers to systems implementations. And I've been finance director, a CIO, and early in my career, I was a financial controller and a project manager. So I've worn many different hats and even had a couple of them on at the same time. Paul, could you say hello?
Yes, hi, good afternoon, everybody. As Susan mentioned, I'm Paul Power, and I've been working with DHL now for over 20 years. Due to the nature of our business within DHL and the fact that we have planes, all sorts of vehicles, and we obviously ship products globally, we have to take ESG seriously. And we've done a lot of work on ESG reporting, but still have much to do. And today I'll give you an insight into aspects of this experience, which will hopefully help others who may be on earlier stages of the journey.
So, as well as talking about how to partner effectively with IT, we'll also talk a bit about the technology fundamentals, how to get through the work. We'll give some guidance on navigating the technology and the consulting markets in this context. But our focus today is on how to go about it rather than what needs to be produced. And on the basis that you're now focused, on the detail of how to put this reporting in place, we'll delve into the nuances of running a large ESG reporting program in partnership with IT. Let's look at this first from an IT point of view. It's an unusual IT challenge. Why do I say this? It's exceptionally broad in scope. The data comes from disparate systems. A lot of the data will come from outside the organisation, particularly for Scope 3 emissions, and some of the data was never recorded before. Also, the standards rollout is ongoing. IT usually insists on really clear scope before they start a project, but finance teams are dealing with new standards and working out how to apply them now. Thirdly, remember that you're competing for IT resource, and the business case doesn't fit the standard prioritization criteria. It doesn't have a simple return on investment number, and it doesn't have a stark penalty avoidance headline like data protection had through the potential fine of 4% of turnover for non-compliance with the GDPR directive. So be prepared to work hard to have it prioritised by your CIO. Let's talk about partnership risks and mitigations. How do you make the partnership work well? The first risk is confusion over responsibilities. Because the scope is so broad, the technology work will probably need to be shared across a number of IT teams. If you have a sustainability team already, then part of your IT team will have built up a relationship with the sustainability team. And remember also the social element, where much of the data will be in HR systems. In combination, this means that ownership could become muddled. How can you mitigate this? This is where really good program management is so useful. And I use the word program rather than project here, because it's likely that a number of projects will have to come together to deliver the reporting. I recommend a two-in-a-box model for the program itself. Two-in-a-box means a tight partnership between finance and IT program managers who are jointly responsible. And if you have a team in IT which is responsible for partnering with the finance team, I would recommend that the head of that team has overall functional accountability on behalf of IT for this, even though much of the work might have to be done by IT personnel in other teams. By having the finance VP as the lead partner, you build on that established relationship. Your finance VP will usually have a good understanding of reporting obligations and their implications, such as the provision of audit trails. The second risk I'd like to highlight is that even though you might have a generous IT budget for this program, IT mightn't be able to find enough resource to get the work done on time. After the big implementations of ERP systems were done and settled down, IT budgets have moved to other areas such as analytics and cybersecurity. So financial reporting IT teams tend to be tightly resourced, and the consulting firms have strong competition for ESG specialists. So the program needs to be scoped out and planned as early as possible. Don't wait for perfect information before resourcing it. And manage expectations. Make sure colleagues realise they'll need to accept some adjustments during the program. The third risk to highlight is motivation. Expect IT colleagues to be sceptical about the level of stimulation they'll experience when working on ESG reporting. Sourcing obscure data and creating reports for compliance doesn't sound as exciting as changing the world in original ways with artificial intelligence or fighting cyber criminals. IT professionals have alternatives. So I recommend reaching out to IT colleagues proactively to make sure they understand how important this is to the business and how it aligns with your values. Emphasize that putting this reporting in place is a good thing to do because it makes greenwashing so much more difficult. Now, over to Paul, who'll talk about the technology.
Yeah, so I was just saying that from a, I suppose, technology perspective, this is not it's not the most technically challenging project. The technical solution needed is relatively straightforward. The technical elements are not overly complex, but the scope of the project is very broad. And the most complex element will be defining and gathering the required data. So when looking at the technology fundamentals, we need to take into consideration a number of points. The first is the various mechanisms and solutions for gathering the data and verifying that the data and verifying that data, which will have many diverse and different sources. We'll also need a solution to manage and process the data to get it into the right format. Again, this will not be seen to be very complex computations, but will be a necessary step to data will come in a format that you may need to change into certain carbon emissions or have it refined in certain aspects, and that needs to be taken into consideration. And once we have the data, and we need somewhere to store it, whether it's a specific database, a data warehouse, data lake, but somewhere that a repository where we'll be able to have this access to this data, as this data will continue to grow over time. And then finally, we'll need a reporting tool to provide visibility at various levels. This can be operational reporting, it can be management reporting, or customer-facing reporting. So from an IT point of view, the solution is not a highly complex technical solution, but the broad scope of the data requirement means that this can be a really big data challenge. And the IT, finance, sustainability teams will all need to work together to define the data requirements initially, and then to work together to understand how they're going to get that into the organization in an efficient way. When we look at the scope of the data challenge, the scope of the ESD data is wide ranging, so must clearly define and set the boundaries of your value chain. So you have the greenhouse gas protocol scope 1, 2, and 3 emissions. Within the scope 1, we have any fossil fuels directly used, so that can include gas heating, generators, emissions from industrial processes, or any owned or leased vehicle emissions. In the past, the cost and usage of these type of fuels would have been captured, but the emission-related data was often not taken into consideration. Now, it is now important to understand that all your emission data within Scope 1 and determine where and how to capture it. And it's I suppose in some respects, it's not as easy as it sounds when you take the multiple type of different vehicles and the way the fuel is used, and then depending on your process within sites, how fossil fuels are used within those locations. The Scope 2 emissions are probably more straightforward to get. It's related to kind of purchased electricity. So this should be easier to centrally manage and identify. But again, in the past, it's often been the case that you may have looked at usage and you may have looked at cost. But the emissions and the carbon effect of that was not something that was necessarily that important at the time. So therefore now we need to relook at how are we capturing that data and where we can store and make that data available for use. Scope 3, I suppose, is where it gets more complicated. And this is where you have indirect emissions from any sort of purchased products and services that you're using. So this can be a much more challenging data collection task. Categorizing into the relevant emission categories can help identify the different areas where the emissions will occur in your value chain. Each of the varied sources of these emissions will require a level of IT collaboration with suppliers and partners within the value chain, and you'll need to agree on the most effective ways to capture this data. A lot of the data will not have been previously captured or recorded, and when you look at the various elements, such as mentioned area of employee travel, waste, commuting, purchased products or services, a lot of new processes will need to be implemented to capture and measure the emissions data associated with these elements. And some of this data may be readily available from suppliers, but some elements may be more difficult and require a lot of additional effort to get and to capture. So to minimize this effort required and help with the efficiency and quality of the data collection, it's important to digitalize as much of this process as is feasible. Within DHL, we've been on this road for a few years now at this stage, but again, we're by no means near completion of this. It's still a difficult challenge in relation to the amount of data and the different types of data that we have to look at and collect. And it's an ongoing process to continue automating as much of this data collection as possible to help minimize that cost and effort of managing that data.
So let's talk about planning to meet the challenge. This is a very high-level straw man plan to meet the challenge. Now, before I talk through it, I want to emphasize that I'm not putting this forward as a formula for success. Instead, I'm presenting this to provoke you to work with your IT colleagues to create a pragmatic plan that fits your own situation. And I'm assuming here that you're starting work now off a low base in quite large business, so you have a lot of ground to cover. I'm assuming also that your first year where you will report it is 2026 and you're reporting on 2025 performance. The important thing to reiterate is that it's likely to be a program of connected projects and not a standard sequential waterfall project. The planning principle is, of course, to work back from the deadline, which is when you need to have the reporting live for external stakeholders, presumably early 2026, and front load the work as much as possible. 2026 is nearly 2 years from now, but to report on 2025 performance, you need data for all of 2025. And this means that substantial work has to be live by the 1st of January next, less than 11 months from now. And you don't want your first real view of ESG performance to appear just as your auditors arrive in Q1 2026. So it's not a simple big bang cutover in early 2026. Some work, which would usually be done sequentially on projects, needs to be done in parallel. This does add some risk, but you need to fast track the data stream. And it's a reporting project, so you don't have to be as cautious in phasing as you would for transaction processing system implementation, for example, or a banking system. Are shown in the middle. From the left, scope the overall program, identify your gaps, use this to size the projects and resource the whole program. In the middle, build changes to your systems and data feeds and identify solutions to fill gaps. And on the right, plan for extensive testing, business change and refinement. I'll talk you through some of the detail in the next slide, but before getting into any detail, assume that your data challenge will be bigger than your technology challenge. This should influence your management of risk. One other point which I haven't mentioned on the slide, when you have to buy some technology solutions to fill gaps, don't allow this to use up a disproportionate amount of attention. And I'll talk about this in more detail in a few minutes. This slide shows the same plan fleshed out further. A lot of text here, so I won't talk you through every line, but if anything isn't clear when you read it afterwards, just send me a mail on LinkedIn, please. First, the scope of the overall program should be examined on the basis of the double materiality assessment and the relevant reference framework. See if there's new functionality for ESG reporting in your current mainstream systems that can be used. Also, how much of the required data currently exists? Is it accessible? How accurate is it? What's the quality of the audit trail? And especially if you're in a B2B business, what reporting do your customers need? Do they really know yet exactly what they need? Remember that some customers are going through the same process as you, so be prepared for a drip feed of customers asking you to provide new data feeds to them. Be happy to work in the early stages with a higher than usual margin for error. Avoid spurious accuracy, manage expectations, and putting it in financial terms, that might mean a high contingency number. But most importantly, bring the resource onto the program ASAP. Now, looking at the next block of work in the middle, assuming that there's some systems and data gaps that you have to find solutions, I'd recommend proceeding with the work on your incumbent systems and on the data feeds in parallel with finding solutions to fill the gaps. In some cases, you might have to compromise and use semi-manual processes. This could then add up to quite a complex overall design, so the IT team should have a very competent architect overseeing the design. When mapping the reports themselves, you can reduce the potential for surprises by using agile methodology and start using the reports internally. But most importantly, in my opinion, start working on business change, especially on deciding what changes you need to make to your operating model. For example, how reporting cycles will work and who will do what in the cycle. And consider your relationship with third-party information providers. How will the relationship work, and put the arrangements in place? You might need to negotiate contractual changes, and you'll need to build controls to check whether the data you're getting from them is complete and meets the accuracy or reasonableness criteria. This is particularly relevant for retailers and wholesalers who aren't making the product, and where the Scope 3 emissions is a huge proportion of their total emissions. Moving to the third block, plan to resource testing heavily because you've no legacy reports to compare against. Be pragmatic with cutover too. Go live with whatever's ready as early as possible. I would recommend building comprehensive monitoring too, so after you go live, you know each month that the process is working from end to end. And recognize that you're going live with new processes and responsibilities and not just reports. So anticipate a significant body of work to tune the model and refine the reporting in 2026 and beyond. Over to you again, Paul.
Yeah, so on screen there you can see kind of a typical data architecture landscape. And as I mentioned earlier, this project is not necessarily a technical difficult project with lots of new technical solutions, but the challenge is the wide scope and determining how we'll capture, store and report on the data. With this kind of simplified overview of a company's data architecture landscape, you see on the left-hand side multiple data sources where the data and scope is currently stored, or when I say stored, it may not be stored even in a digital environment. It may be stored in a manual filing cabinet or piece of paper. So the ERP and finance systems will have some of the data based on, say, usage and cost maybe, but the actual emissions data may be missing. Depending on the organization overall, there could be multiple ERP systems and multiple transport management systems. Some of the transport management systems may be, again, spreadsheet-based solutions or not full kind of TMS solutions. And then you'll have product solutions, third-party applications, local databases, spreadsheets, and paper files, which all may contain some elements that are required to capture the emissions information. So I suppose this is where it gets this going back to defining your boundaries and defining the relevant elements that we need to capture is so critical, and then identifying exactly where they are currently. And if we don't have them currently, how can we get access to them? So once we've identified the sources and how to capture the data, it's then necessary to try and integrate all that data together and then do some data processing on it. So potentially do some calculations and conversions to determine the required emission factors. The data then needs to be stored obviously in some sort of central location, some sort of central database, data warehouse or a data lake, so that the reporting requirements can be developed. The various different levels of reporting required for either regulatory or legislative requirements and reporting analysis used by your own organization. And within DHL, we'll be using that type of reporting to help drive down our emission levels, so we can obviously identify exactly where we are and where our highest emissions are and how we can use that information to actually then reduce the emissions. We also have started to develop customer dashboards, and the customer dashboards are there to provide visibility to our customers on the emission outputs related to the activities they have with us. So these dashboards are becoming more and more important for our customers. And we're also looking at ways on how we can make this data actually easily available to the customer. So obviously a dashboard is a nice visual of it, but obviously can they also get access to this data in a more digital way? So we're looking at API connectivity for customers, that they can come into DHL's environment and pull the data automatically, and whether that's at kind of down to even individual shipment level, or even before they actually ship something, can they get an accurate estimate of what their carbon emissions will be, and allow the customer then to make decisions on the best way of shipping goods. So all of these type of solutions within our organization are still, a lot of it's still in its infancy stage, but we put a lot of investment in to try and make it as easy as possible, both internally and externally. As I mentioned, digitalizing the data capture is key. For efficiencies, accuracy, quality, digitalizing this data is so important. Many organizations do not have, many organizations now have climate targets. So within DHL, we aspire to being a climate neutral logistic provider by 2050, and by 2030 to reduce our own scope 1 and 2 emissions by 42% and scope 3 by 25%. But the starting point, I suppose, to be able to even look at that is to be able to start measuring it accurately. And that's where I suppose a lot of the work has gone in over the last couple of years to get to the point that we now can say, yes, we are measuring it relatively accurately, but at this point, there's still a lot of manual effort and a lot of manual tools in place to be able to deliver that. We're investing a lot of money in driving our ESG agenda, but even with this investment, the ESG data capture is still a big challenge. Just I suppose to give you some numbers on the challenge, like DHL, we've 300 aircraft, 120,000 owned or leased vehicles. There's over 12,000 locations. So trying to standardize and get the right information across that scope is a big challenge in itself. We have hundreds of source systems, so hundreds of suppliers, third parties, etc., where all this data needs to be pulled from and collated into central databases. Looking at the left-hand side of the diagram there, I mentioned, starting at the bottom, we have people. So in many of our locations, people have to go and record the data manually and then put that data into a spreadsheet, and then that spreadsheet will get fed up into central systems for processing and reporting. We have a few simple solutions whereby we may receive invoices from third parties with carbon data or emission data related to that, and we may just put that through some sort of OCR scanning solution, which again extracts the relevant data and makes it available. We have certain solutions where we receive specific files in an electronic format from customers, and then there's solutions like telematics data from vehicles, which again, we can grab some of that data digitally, bring it in and merge it with the other data to make it available for the reporting. So it's not overly technical difficult, but it is an ongoing challenge to digitalize and automate as much as this is possible. With various levels of automation where data is received, and this automation is an ongoing process, and it's developing each time. And as the legislation develops and as the requirements develop, we have to make sure that we're developing with that. But it is a large, I suppose, project, and it takes a lot of effort and a lot of time from the relevant IT team because of the disparate nature of the information. So from David mentioned earlier about David mentioned earlier about how the market for ESG reporting is developing and where to go for insights. So as you'd expect, with this type of requirement, all the ERP vendors are adding ESG data capture reporting solutions to their systems. Some are embedding it into the existing system, some have it as an add-on feature. Social reporting is also established in the relevant HR platforms and payroll systems. And there's also dedicated platforms from kind of new emerging companies who've created solutions specific around ESG reporting and carbon accounting. With the specific point solutions for data, which is not being traditionally captured and reported externally. And you see now in product information management systems, these platforms are being extended to gather and hold sustainability data on products so that the information is readily available for those who are using those products. From an overall kind of market perspective, obviously the Big Four and the relevant consulting firms are all involved in trying to provide the relevant ESG expertise. But as David mentioned earlier, again, it's a new area, it's still a developing area, so it depends. There's often different levels of capability there and different levels of expertise which you can use. When we look at some of the actual specifics, again, we've looked at it internally and we see that all the big guys are implementing various different levels of ESG management and reporting software. You have SAP, Oracle, Microsoft, Salesforce, Sage. They've all developed solutions which are available to use on all different levels of capability and potential. I mentioned the specialist technology providers new to the market. So a few of them around. So you have the likes of Greenly, Green Project, Persephone, Carbon Analytics. And again, these all provide kind of software as a service, online reporting capabilities and data capture capabilities where they may be pre-integrated into the large kind of energy providers around the world, or in certain countries they'd be integrated to other providers in that area. And it's a growing business, I suppose, and they see it as a growing opportunity. And there's lots of potential solutions out there that, as well as large enterprises can use, but they also have offerings for small and medium enterprises. But again, with any of these solutions, it's making sure that it's the right fit for the overall IT architecture. And the solution itself may look great with all the nice reporting, etc. But the key is actually getting the underlying data in an efficient and an accurate manner. As I mentioned, as the legislation develops, these solutions are developing continuously as well.
So I want to talk now about technology vendor relationships and how your partnership with IT can strengthen your position and drive pace. So if you saw the last slide from Paul, the sheer amount of options you have in terms of technology is huge. And there's a risk then that you get lost in trying to fill the gaps and spend a disproportionate amount of time and attention dealing with the technology vendors. Now, I'm sure many of you have been involved in technology procurement processes, or at least been on the fringes of it, so you know that it has particular features. Awarding deals can take a surprisingly long time. The contracts themselves can be long, legalistic, with specialized terminology that varies from one vendor to another. The big tech multinationals are usually very inflexible on contracts, and the local team usually have very little discretion on variations from the standard. And on the other hand, some of the small vendors can have quirky terms or vague contracts that need to be checked out very thoroughly. So why is this relevant to your partnership with IT? Some of the salespeople from the technology vendors will aim to spend as much time as possible with the potential users of the technology. They want to show you the features of the application with IT out of the room until the last minute. This enables them to impress you without IT personnel like Paul asking difficult questions about technical aspects like interfacing. Plus, they can start to upsell additional features and even whole modules which you don't immediately need, and that can then blur the scope. So stick with your agenda and stay united with IT. Have the relevant IT person with you when dealing with the vendors. Second, quite a few of the technology solutions in the ESG world are relatively new. So before committing time, establish their commitment to your industry and your geography and check their financial stability. I recommend having the IT procurement person involved as early as possible because this can save time later. I'll mention 3 watchouts on this. The first is licensing and pricing. It can be hard to project the ultimate cost, especially if the licensing model is confusing and your own future ways of working are unclear. So pin this down early. For instance, you should be sure that you're being quoted in full for all the features that you need. Second, you might need to spend money on other parts of the technology stack. Again, a reason to have your IT colleagues involved early. And third, if a number of complex deals need to be run past legal people, then this can become a bottleneck. So allow for this when you're planning the pace of the whole program. So talking about pace, I'd like to finish by focusing on 3 ways to drive pace. The first, leading with an energetic, pragmatic tone. Because this is an ESG program, well-intentioned colleagues can veer towards perfectionist outlook, but CSRD compliant reporting has to be in place by the deadline, and of itself, that's huge progress because it establishes comparable reporting and it reduces greenwashing opportunities. Some of the technologies solutions might have to be clunky or inelegant to be ready on time, and you heard from Paul that even huge organization like quoted business like DHL still with some quite basic technology solutions to get the data. So the solutions might be clunky, but that's still a success. After it's live, then it can be refined and improved. Also, it needs full executive team sponsorship all the way through, not just from the CFO and the CIO. For instance, the purchasing team might need to negotiate if data is needed for suppliers. So the commercial director needs to strike the right tone to support them. Second, consider bearing the cost of market insight. Subscriptions to insight providers are expensive, but when you're in unknown territory searching for technology solutions, it can save a lot of time. It also helps prevent expensive mistakes. and act fast if you need consultancy, and leverage existing relationships to ensure that you get the best consultants on your program. Or if you don't have IT on resource, if you don't have your IT resource on board yet, then how can you cover as much ground as possible? I recommend talking to your IT business partner to identify how much ground finance can cover right now, and how this work can be done in a way that allows the IT resource to hit the ground running when they do start. For instance, have IT give you a comprehensive data mapping template and do as much data mapping as possible now in a format that IT will need. Where you need the data from third parties, establish how these third parties communicate right now. Do they send PDF bills or electronic reports with data? Do the suppliers seem to be tech savvy? In other words, anticipate the level of difficulty so you can point IT towards these suppliers first if automated data feeds are needed. And find out what their contractual terms are. If you're going to need the supplier to take on additional work, how strong is your position likely to be when you ask for it? So, to sum up, we set out to give you food for thought and to help you to partner effectively with IT in building this reporting, and we hope we've succeeded. 3 takeaways from this call. Recognise that it's an unorthodox shared challenge and a huge opportunity. Think data first, technology second, and remember the power of a good partnership with IT. Thank you.
Thank you very much, David and Paul. That was really interesting. I've clicked the button to unmute myself. I hope that's worked, and also to start my video, which I also hope has worked, but I just can't see it on the screen there. So unfortunately, you'll have to, hopefully it's working. I'd love if you could keep this slide on the screen, David. Actually, I think it's Paul who's driving the slides, but I think, and I got a text there from Chris, all good. Thank you very much. Because I have some questions that I wanted to ask already. So I was going to use my, abuse my privilege as a host of the webinar to just get my own ones in first, and with apologies to our attendees. But one of the things that really struck me was, you know, you're mentioning, both of you, you're mentioning collaboration. And while the title of this webinar was Collaboration Between Finance and IT for this, it looks like it's collaboration across such a wide range of stakeholders, because you've also got, you mentioned greenwashing, so then you've got your communications team in there as well, not to be promising something that it might be misleading, that you mightn't be able to deliver, and also your procurement team as well, and consultants, and also outside experts who are coming in. So that was one reflection I have, which is just the need for sharing. And, you know, you mentioned there in the slide, together we can do great things with this partnership that's needed. But so that was more an observation rather than a question. But the question I have for both of you is, obviously, you know, DHL is enormous, and you mentioned 12,000 locations. So that's just, for most small companies, obviously, that's kind of mind-boggling. And I'm speaking here from the perspective of someone working as a sustainability kind of professional within an SME, because Chartered Accountants Ireland is an SME. So you mentioned IT architects, David, and Paul, you talked about the right fit for your IT architecture. Do you think that the approaches that you have taken and that you're familiar with through consulting and strategic and change management, do you think those can be right-sized to small businesses who might not have to report necessarily on CSRD, but who are in the supply chains and who may have to be kind of disclosing information or describing information? So is there the same requirement basically for this kind of collaboration at that level?
Let me jump in there. So absolutely. I mean, the collaboration is vital. Now, so a couple of things, and this might be me just talking as a person who is really a program manager by profession. So because even if it's a small business, it's still affecting a significant number of stakeholders and the different teams across that business. You know, so program management, project management, that coordination skill is still really important. And you know, the partnership between IT and finance, to my mind, is the core partnership when it comes to reporting, because that's the disciplines come from the finance profession, usually. And I think an awful lot of the onward communication of it is built upon a sound base which is put in place by the systems and the finance people. So, to my mind, it's equally important, but obviously the approach can be simplified. What I laid out here in terms of that program plan was for quite a big organization with, a complex operation, but the same basic principles apply.
Funny you should mention, the complexity of it. And so I'm imagining that a lot of companies would use past experience and past projects that would have dealt with similar, certainly that have dealt with complexity, but maybe not necessarily a similar kind of level of complexity or complexity in this way. But they certainly would have had structured kind of project methodology to deal with these projects. And they would have spent energy learning lessons from that. But we're talking about kind of a new departure. There's a lot of kind of unstructured data. There was data lakes being mentioned, certainly by yourself, Paul, and also different types of data feeding in to all of this that might have been kind of generated in hard copy, or certainly they're inputted into an Excel spreadsheet and then brought into all of this. So a lot going on, a lot of data coming from HR, potentially from different sources. So to deal with that, you are kind of almost talking like implementing kind of a different type of methodology and maybe an unstructured approach. And does that add a lot of risk? And before I even let you answer that question, I had an interesting question come in which talked about risk, and I'll just roll them in together kind of for ease. And that was, to what extent internal audit and risk management need to be involved in this early stage to avoid issues later. So I appreciate there's two parts to that question. One was, are we suggesting there's risks in implementing an unstructured approach, and should the audit, internal audit and risk management be involved at this stage?
Yeah, the first thing is, it's not, the approach I set out there is not intended to be unstructured to the extent, say, of applying agile methodology to a complete program of this scale. Okay, so it has to be very structured, because you're coordinating so many different strands, and you've got a hard deadline. On the other hand, it doesn't follow a kind of a formulaic project plan, as a lot of people would have originally learned in big SAP Oracle financials implementations back in the 90s and early to mid 2000s. So, and remember that effectively you've got a data deadline, which I think in a lot of cases is actually the 1st of Jan 25. And then you've actually got the reporting deadline in early 26. So it is unorthodox. So I think the skill in terms of structuring the program is to apply the right tools for the job. So I think you need experienced program management who have experienced different styles of programs in order to design something that works, and be ready to make some changes to the program as you learn more through it. The next question then is on internal audits. Now, I might frighten some of the internal audit people, but I would first say that it's because it's not a transaction processing project, the penalty for having something that isn't completely perfect isn't extreme like it might be if it was accounts payable or accounts receivable, or your whole order management cycle. Okay, so through the program you can, it's a blurry picture that's getting clearer. Now, however, it is absolutely no good for your credibility or for what you're trying to achieve if you end up with a set of reports that you can't stand over. So what now, I haven't thought about this much, but my recommendation would be, where internal audit needs to come in early, and the kind of financial control professionals, financial reporting professionals, is what is the level of accuracy or reasonableness that's applied. Okay, especially for something like Scope 3 emissions, where you're reliant upon suppliers to give you the data. And so what controls have you got over reasonableness and accuracy and completeness, first of all, and secondly, the move to the reasonable assurance criteria in audit, which I personally haven't experienced because I'm a traditional accountant by background, but the what level of audit trail is then required for your auditors to give that level of assurance. So I think at the early stage, I think there's a significant input from internal audit and from financial reporting teams and experts to actually set the criteria, because that then allows IT to work at pace, knowing that the goalposts aren't going to change.
It's an interesting point that you're making about, who is setting the criteria. And that sort of harks back to the early part of your presentation, David, where you were talking about the kind of crisis of ownership, of who owns what, who's responsible for what, who's defining what. And it actually makes me think of something, this question possibly for Paul, rather. A lot of the finance teams, because so much of this is going through the finance teams, they're talking about kind of maintaining ownership of this. But if a business, especially a large business, has a head of sustainability already, and they have built a partnership with IT, would the simplest solution be then for this to be a sustainability finance kind of partnership, maybe for the sustainability people to provide the reporting to finance? Just in terms of the involvement of IT in the whole process.
Yes, now it's, I suppose, within DHL, because as we were so large, we do have sustainability teams. But from a reporting perspective, finance still take ownership. So the sustainability teams, obviously, it's a collaboration between finance, sustainability, and IT. But the sustainability teams, I suppose, take ownership really for defining what's needed, and then the finance team take ownership for delivering that. And partly because a lot of the information was in traditional financial and accounting systems, and obviously finance teams are producing regular reports already. That it's starting to change slightly now when you start to get into customer reporting. So from the customer reporting and the dashboards, and then building technical solutions to make the data available to customers, the finance team are not as heavily involved in that, and it's more sustainability and IT teams together than working on that element. So depending on the specific, now obviously around the actual required reporting from a regulatory perspective, that's still owned within the finance teams, and it's kind of part of their overall finance reporting requirements. But yeah, you're starting to see sustainability teams take ownership for certain aspects of reporting more and more.
And certainly from what I was seeing in the bigger companies, there's maybe a trend for sustainability to report into finance anyway. So that is almost kind of covered off through an organizational structure way. But actually for both panelists, do you see change management featuring very heavily in this? And from your own experience as with change management and organizational transformation, do you think that's another piece that businesses have to take account of?
Yeah, absolutely. The first thing is that big systems implementations are hard work, and everybody then starts talking about risk, especially when you've got a deadline. So it can feel sometimes like a chore. But so where the first thing on change management is that the belief that this is the right thing to do has to be really well communicated and demonstrated by full exec. I mean, the example I gave there was, if you've got to negotiate with suppliers, you need your purchasing team, or whoever's doing the negotiation, needs to be prioritizing that and not kind of focusing completely on commercial terms and saying, by the way, somebody from IT told me you might need to give them 1 or 2 reports, So they need to be very clear that this is important. And the second thing is that to actually run it dependably and efficiently after you go live with the first year's reporting, you're going to have redesign of jobs. The technology is actually going to take some getting used to. So I would expect that there's, it's going to drive unexpected change to the operating model, and jobs will actually change. you might argue that there's a kind of a profession almost that will grow out of it, which is what sustainability reporting. I don't know if we call them sustainability accountants or what, but it's going to drive significant change to how teams are constructed in the relevant areas. So, and sorry, let me mention the third thing on change is the risk of focusing completely on internal factors in your operating model, but in fact your model of engaging with service providers and suppliers needs to change so that the ESG reporting, getting all the data, etc., isn't an afterthought that's layered on. It's actually built into selection criteria, built into standard contracts, etc., if you need the data. So the implications of this are quite significant, and the risk, of course, is that in focusing on getting the reporting ready for the deadline, that you don't think through all of the other elements, and you don't get enough people involved and allocate the work to everybody as it should be allocated.
Yeah, and just to add to that, you mentioned about the operating model changing, like within DHL, obviously as the reporting is there, we have to filter down to the operation. So it's not just, we mentioned kind of the finance, sustainability and IT teams collaborating, it's also sustainability and operations collaborating. So when you're looking at things like a climate neutral building, you have to make sure there's procedures in place to make sure that stays that way, that somebody doesn't do something that suddenly we're using some product or something which no longer makes that building climate neutral. So it's an ongoing process to be able to manage and making sure that any decision made in the future, whether it's a procurement decision or whatever it is that it stays within the principles and follows the needs to make sure that we are achieving our climate targets as such. And whether that's a new vehicle, a new way of purchasing electricity, or whatever it is, it all has to fit into the model and to the agenda that we're on the journey with.
So basically, people should have started well before now. Which is the answer. We just
Like
what we're always
project.
told. Yeah.
All projects should start earlier.
Yeah, absolutely. Look, on that note, I'm going to have to wrap up because even though I thought I'd loads of time, I looked at my watch and it's 12:54. So this happened. I was just I was too interested in what you were talking about to do my job of hosting. But I'm afraid I'm going to have to wrap up now and thank our speakers for that. A really interesting webinar. And I wanted to let all of our attendees know that Chartered Accountants Ireland has resources on the topic of Corporate Sustainability Reporting Directive. And I'll put a link in the chat to where you can find these resources. Ultimately, it's on the Chartered Accountants website, and you can go into the Sustainability Centre in the Knowledge Centre and click on resources, and they link out to other departments in the Institute. We also have, there's a technical alert on the CSRD, which is a questions and answers document, and some webinars there, which I think could be very useful. Also, there's more to come from the Institute on the topic of sustainability. So please do keep an eye out on our weekly newsletter from the Institute that comes out on a Friday. And our technical roundup from the professional accounting team publishes every fortnight. There's also my own sustainability bulletin, which I put out once a week on wider sustainability issues facing the businesses and the profession. And you can also find this on LinkedIn. But thank you very much for coming to everybody. Thanks to our audio visual support lead, Chris Donoghue, and of course to our wonderful speakers, David Codd and Paul Power. And so keep an eye out for future webinars. Okay, all the best, everyone. Bye for now.